The DTCC will deny everything. Today I want to talk about why the DTCC and some major players like Citadel are currently putting measures in place to deny everything with plausible deniability during the AMC squeeze, during the market crash, and during the collapse. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Hang Loose tweeted saying this is eerie as hell. It's almost like the DTCC knows they need to allow the shorts, brokers and market makers the ability to stuff retail accounts with counterfeit shares for the GameStop dividend, which is insanely criminal, but they also need to be able to claim ignorance and plausible deniability. So the DTCC just sent out an elimination of email notifications of client short positions. So it says beginning July 19th, aka yesterday, through to December 31st, 2022, the DTC will continue sending clients an email informing them they've incurred a short position. However, in an effort to reduce cybersecurity risk, the QSIP or security identifier and the quantity of shares shorted will no longer be included. And as of the 1st of January 2023, those emails will be eliminated entirely. They won't get an email just confirming an open short position. They won't receive any email at all. The DTC is now saying, no guys, we don't need to know what company you're shorting, and we don't want to know how many shares you're actually shorting either. We just want to know if you're shorting companies or not. They're saying, guys, please don't tell us how many shares are being shorted of what company, because we don't want to know, because we need this plausible deniability. I think when the market crashes and when AMC squeezes, the DTCC and many major employees at these corporations like Ken Griffin are going to use their plausible deniability and say, no, I didn't know how many shares were being shorted, I didn't know what companies we were shorting, and therefore I couldn't possibly know about any illegal activity. If Ken Griffin doesn't see this DTCC email every single day, how can he possibly know how many shares of AMC or GameStop were being shorted, and how could he possibly know there were indeed synthetic shares? And it seems like Ken Griffin is already making plans of his own from this recent tweet from Nazim. He said hedge fund billionaire Ken Griffin plans to build an 8-acre estate in Palm Beach for his mum, a 44,000 square foot mansion. And he asked whose mum needs a mansion of that size. Nazim thinks Ken Griffin is starting to transfer assets out of his name into the names of other people. Money laundering 101. This article from the New York Post says billionaire Ken Griffin's Palm Beach mansion for his mum has the neighbours fuming. The article says the news isn't sitting well with Griffin's uber rich neighbours, who were already upset about the hedge fund mogul spending $450 million buying up several parcels of land in order to lay the groundwork for construction of the home. This here is some of the planning permission photographs for Ken Griffin's new mansion, or should I say, sorry, Ken Griffin's mum's new mansion. I also saw an article that said Ken has recently spent over $100 million on a new apartment in New York, over $60 million on a new flat in London, and millions more dollars on other properties as well, likely not in his own name. Clearly Ken is trying to transfer money from his own name into other people's names while claiming this plausible deniability during the market crash and during the AMC squeeze. And one reason why this plausible deniability is soon going to be needed is a result of this tweet from Gold Telegraph. And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 10 free stocks worth up to a total of $25,000. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. If you didn't already know, from Moomoo's latest customer agreement, they officially state they do not benefit from your order flow, and they do not sell your order flow to market makers like Citadel or to clearing houses like Apex Clearing. In fact, they clear their trades on their own through their own clearing broker, Futu Incorporated, which does also not sell your order flow. They said big investors have cut their allocations to equities, they've taken money out of stocks to the lowest level since the collapse of Lehman Brothers. Meanwhile, central banks are hiking interest rates until they break something. So clearly many of these major banks, like Goldman Sachs and many major institutions, have been taking money out of the stock market at an alarming rate while interest rates are being hiked because of the coming collapse and the coming recession. However, many of these hedge funds are stuck and they can't take their money out. Many of these hedge funds are over leveraged on their short positions and over leveraged on their long positions and simply can't exit the market. market. If they tried to sell off all of their longs and they tried to cover all of their shorts or close out of all of their shorts, they would cause the squeeze and they would cause the market crash. And therefore, while many hedge funds are taking money out of the market, many hedge funds are also stuck and they're just waiting to see what happens and effectively waiting for the collapse. Ben Rickert tweeted this graph and said that fund managers' extreme risk aversion compares to the 2008 collapse. We can see the number of funds taking higher than average risk levels, and the number of funds taking money from the stock market is larger than it was back in April of 2020, almost at the same rate as October 2008. The net percentage of outward equities versus cash is currently over 100%, just like it was back in 2008. Clearly, many institutions are taking money out of the stock market as they know a recession is just around the corner. But these hedge funds that are stuck will be the ones feeling the pinch and will be the funds being liquidated. And speaking of which, Unusual Wells tweeted saying more home sellers are dropping their asking prices as rising mortgage interest rates and inflation have eased competition in the housing market. The Real Fly also tweeted saying the housing market is in price collapse mode. He said, here are cities with the most price cuts. So many cities in Idaho, Colorado, Utah, Washington, and many other states or many other cities in these states have been cutting the asking prices of their properties by 61%, 55%, 51%, 49%, and more. Clearly, homes aren't selling due to the rise in prices and due to the rise in interest rates, and that's why so many homeowners are having to cut their prices to sell their properties. And Livingston tweeted saying this is a result of mortgage demand dropping to the lowest level in 22 years. Not just mortgage demand dropping to the lowest level since the pandemic, but dropping to the lowest level lower than in 2008, all the way to the lowest level since 2000. The CNBC article says mortgage demand drops to a 22-year low as higher interest rates and inflation crush home buyers. It says buyers have lost considerable purchasing power as rates have almost doubled since earlier this year. And it says the pain in the mortgage market is only getting worse as higher interest rates and inflation hammer American consumers. Applications for a mortgage to purchase a home dropped 7% for the week and were 19% lower than the same week in 2021. And that's effectively because loans with a 20% down payment last year had an interest rate of 3.11%. But now that same interest rate or that same mortgage structure would carry a rate of 5.8%. So in the last year, interest rates have nearly doubled and home prices have also increased alongside. And I think Joseph Brown has given an excellent real-life scenario explaining the problem. He said, hypothetically, your car payment is $300 a month and you can easily afford it. You paid $30k for the car, but you could sell it for $40k. However, if you sold it, you'd have to downgrade cars and the new one would actually cost you $700 a month, which you can't afford. And he said nobody would take that trade, but this is housing. You bought a house last year and you can sell it for more, but when you bought that house last year, you got a good deal on a 30-year fixed rate mortgage. Now, if you want to sell that house and recognise those profits, you have to buy a new house, which is likely going to be smaller as prices have increased, and also your mortgage rate or your mortgage interest payment is going to be way, way higher. And that's why people aren't selling their houses at the moment, because if they did, they'd have to downgrade to something smaller and more expensive. And Unusual Wells has also tweeted saying people have asked how long this bear market will last. He said, while the conditions are importantly very different, he said, take a look at this chart discussing length and whether there was a recession or not. So this chart shows the number of months from the bear market bottom to the previous high. So in all of these years previously, yes, we have on occasion seen times where it's only taken 5 or 6 months to go from the bottom to the high, but in many circumstances it's taken 24 months, 70 months, 49 or even 56 months. The average time for a recession to play out so far has been 24 months, and therefore, considering we're only 6 or 7 months into the current recession, it's likely to last a lot longer, and we likely haven't seen the bottom of the market so far. Considering we likely haven't seen the bottom, considering all of these hedge funds are pulling cash out of the market, and considering the DTCC and major institutions like Citadel are preparing for plausible deniability, this has led to some big hedge funds actually increasing their positions in AMC. French Ape tweeted saying big players increased their positions in AMC by 136% to 965%. That's some hedge funds 10xing their current AMC position because they know something that we don't. And he said all of these institutions also bought big on call options. And he said you don't place this kind of investment on a dead cat or on a failing company. Many of these funds and institutions have bought hundreds of thousands of new shares and have increased their positions by 965%. Clearly, these funds are not only preparing for the market crash, they're also preparing for the AMC squeeze by buying more shares and buying call options. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.